So let me ask you something. If I told you the government was offering you a retirement account where your money could grow completely tax-free, meaning every single dollar of your gains, your dividends, and compounding interest over the next 30 years, you would end up owing zero in taxes when you pull it out. Would you sign up? Most people would say yes immediately, and honestly, that's the right call. But here's what's wild. Millions of people either don't have that account, aren't putting enough into it, or don't even know if they're eligible for it. It's like being handed a golden ticket and leaving it on the counter. And on the flip side, there's another version of the same account where you get the tax break right now, today, this year, a deduction that actually lowers your taxable income when you file. Some people need that more. Some people don't. And knowing the difference between these two accounts could literally be worth tens of thousands or even hundreds of thousands of dollars over the course of your investing life. We're talking about IRAs today, the individual retirement account, both the traditional and the Roth version. If you caught our last video where we broke down 401ks, think of this as the next chapter. IRAs, 401ks are kind of like cousins. They're both built for retirement. They both carry tax advantages, but they work differently. They have different rules. And for a lot of people, the smartest move is using both together. We'll get into that. Before we get too far into anything today, I want to be clear. I'm not a financial advisor, financial consultant, or licensed investment professional. Nothing in this video should be taken as personalized financial advice. Everything I share is always for educational purposes only. Always do your own market research, and when in doubt, consult with a certified financial planner or advisor who understands your personal situation. So what is an IRA? An IRA is an individual retirement account. It's a tax-advantaged account that you open yourself independently through a brokerage or other financial institution. And this is the key difference from the 401k, which is tied to your employer. Your IRA has nothing to do with where you work. Nobody at your work sets it up for you. Nobody has to approve it. You go, you open one, you fund it, and you get to decide where it lives. Whether that's Fidelity, Vanguard, Schwab, anywhere else. It's completely yours. Think of it this way. 401k is the retirement plan that your employer puts on the menu for you. IRA is the meal you get to cook yourself. You pick the ingredients, you control the kitchen, you don't need any permission to get started. Inside that IRA, you can hold a wide range of investments, stocks, bonds, ETFs, mutual funds, REITs, and more. Unlike a 401k where your investment choices are limited to whatever menu your employer offers, with the IRA, you're in the driver's seat. You choose the account, you choose the platform, and you choose exactly what you invest in. It's not just a savings account, it's an investment account with a retirement tax wrapper around it, and you have full control over what goes inside. There are several types of IRAs out there, SEP IRAs, simple IRAs, and others designed to work for self-employed folks and small business owners, and we'll cover those in their own video. Today, we're focused on the basics, the two most common, most discussed, and most universally applicable, the traditional IRA and the Roth IRA. These are the two that any individual with earned income can typically access, and they operate on opposite sides of the tax equation. So let's meet them both. First, let's discuss the traditional IRA. The traditional IRA has been around since 1974. It's the original. Its core appeal is simple. You may be able to deduct your contributions from your taxable income today. This lowers your tax bill right now, and your money grows tax-deferred until retirement. Here's how that works in plain terms. Let's say you earn $60,000 this year. You contribute $7,000 to a traditional IRA. Depending on your income and whether you have access to a workplace retirement plan, you might be able to deduct that entire $7,000 from your taxable income, effectively only having to pay income tax on $53,000. The IRS looks at your return and sees a smaller number. That's a real money put back in your pocket today before your investments have done a single thing. Your investments then grow inside that account without you paying taxes on gains year over year. No capital gains tax, no dividend tax eating into your returns each year. It all compounds untouched, like a snowball rolling down the hill with nothing in the way. So what's the catch? When you pull the money out in retirement, you pay ordinary income tax on it. Every dollar, contributions and growth alike. The IRS has been patient, and eventually they're going to want to come to collect. The bet you're making with the traditional IRA is that your tax rate in retirement will be lower than your tax rate today. If you're in a higher bracket now, say you're in your peak earning years with a strong salary, and you expect to make a more modest income in retirement, the traditional IRA can be a really smart move. You're essentially saying, I'd rather pay taxes later at a lower rate than pay them today at a higher one. And that's a reasonable bet for a lot of people. As for the pros of the traditional IRA, we have the potential tax deduction today, the immediate relief on your tax bill, no drag from annual taxes on dividends or gains, which is a good fit if you're in the high tax bracket now, and it can be a strong tool during your peak earning years. For the cons of the Roth IRA, there's no upfront tax deduction, so you don't get that immediate relief on this year's tax bill. There are income limits. If you earn above a certain threshold, you may not be eligible to contribute directly. We'll cover some workarounds in a bit. If your tax rate in retirement ends up being lower than today, you may have been better going off the traditional route. And they're less impactful if you need a tax break now and are already in a high bracket today. Now let's talk about the Roth IRA. And I really want you to pay attention here because for a lot of the younger investors or anyone earlier in their earning career, this account can be an absolute powerhouse. The Roth IRA flips the tax equation entirely. You contribute money that has already been taxed, meaning there's no deduction up front, but your money grows completely tax-free, and qualified withdrawals in retirement are 100% tax-free. So let's use the same example as before. You earn $60,000, contribute $7,000 to a Roth IRA. You don't get a tax deduction. You still owe the tax on that full $60,000. But 30 years from now, when that $7,000 has grown into $40,000, $80,000, maybe $100,000 through decades of compounding, you pull it out and owe $0 in taxes. Not a single penny. IRS no longer gets a seat at the table. That's a significant deal. If the traditional IRA is a deal where you pay taxes later, the Roth is the government saying, pay us now, and we promise we'll never touch the money again. It's like paying off a bill up front so you never see it versus putting it on a tab that keeps growing. For anyone who believes their income or tax rates in general will be higher in the future, locking in today's rate can be a very smart play. And here's something that doesn't get talked about enough. The Roth IRA is also a phenomenal estate planning tool. If you never need the money in retirement, it can sit there compounding indefinitely, tax-free, and eventually pass on to your heirs. That's a level of flexibility that's hard to beat. As for the pros of the Roth IRA, we have the tax-free growth and tax-free qualified withdrawals in retirements. No RMDs, meaning you're never forced to take money out. Contributions, not earnings, can be withdrawn at any time, penalty-free. More on this in a minute. It's excellent for younger investors or anyone who expects to be in a higher tax bracket later in life, and it can serve as a powerful estate planning tool. For the cons of the Roth IRA, there's no upfront tax deduction, so you don't get that immediate relief on this year's tax bill. There are income limits. If you earn above a certain threshold, you may not be eligible to contribute directly. We'll cover some workarounds in a bit. If your tax rate in retirement ends up being lower than today, you may have been better going off the traditional route. And they're less impactful if you need a tax break now and are already in a high bracket today. All right, so let's talk some numbers, specifically for 2026. For both the traditional IRA and the Roth IRA, the contribution limit for 2026 is $7,000. If you're age 50 or older, you're eligible for catch-up contributions that bring your total up to $8,000. One critical thing to understand is that $7,000 limit is combined across both account types. You can split your contributions however you want, be it $3,500 traditional, $3,500 to Roth, $6,000 to one, $1,000 to the other. You get total creative control, but the combined total of contributions cannot exceed $7,000 or $8,000 if you're 50 or over. Think of it as one shared bucket, not two separate ones. And here's where it compares notably to the 401k world. 2026 401k employee contribution is $23,500. That's more than 3 times what an IRA allows. For a meaningful gap, high earners or aggressive savers, the IRA won't cut it alone. That's precisely why many financial educators and planners suggest contributing to both. Maximize the employer match on your 401k, fund your IRA, then go back and add more to the 401k. We'll talk about more how that layering strategy actually works in a later section. Now, the IRA does have some income guardrails. Not everyone can contribute directly, and that's worth knowing before you assume you're in. For the Roth IRA, your ability to contribute phases out based on your income. For single filers, the phase out begins at $150,000 of modified gross income. It's completely eliminated at $165,000. If you're married filing jointly, the phase out begins at $236,000 and is eliminated at $246,000 for 2026. If you're above those thresholds, you can't contribute directly to a Roth IRA, but you're not necessarily locked out forever. There's a strategy called the backdoor Roth IRA that lets high earners still get money in through a side door. It involves contributing it into a non-deductible traditional IRA and then converting it. It's legal, it's widely used, and it's something we'll dig into in another video down the road. For the traditional IRA, anyone with earned income can contribute. No income ceiling. However, the ability to deduct that contribution phases out if you or your spouse have access to a workplace retirement plan and your income exceeds certain limits. In that case, you can still contribute to the traditional IRA, it just becomes non-tax deductible. This changes the math significantly. If you're in that situation, the Roth often makes more sense. You're not getting the deduction either way, so you might as well get the tax-free growth. So how do you access your money? Both IRAs are retirement accounts, and the government has built-in guardrails to make sure the money actually stays there for retirement. Think of it like a lock on the cookie jar. It's there to protect you from yourself. But it's important to know exactly how and when those locks open. So the standard rule for both traditional and Roth IRAs is 59.5. This magic number is the standard age at which you can begin taking withdrawals out without any early withdrawal penalty. For traditional IRA, withdrawals after 59.5 are penalty free, but they are taxed as ordinary income. You got the tax break on the way in, so now you pay on the way out. Straightforward trade. For the Roth IRA, withdrawals after 59.5 are both penalty free and tax free. But there's one extra rule to know, the 5-year rule. At least 5 years must have passed since you first contributed to a Roth IRA before qualified distributions are fully tax-free. So if you open a Roth IRA at age 57 and want to pull out money at 60, you'd satisfy the age requirement, but you wouldn't have cleared the 5-year clock yet. It's a nuance that catches people off guard. So the takeaway is open a Roth IRA as early as you can, even if you're only putting a small amount in. Start that clock early. So what happens if we need to access our retirement funds before 59.5? Life doesn't always cooperate with our retirement timeline. Emergencies happen, plans change. Sometimes people need to access their money earlier than they expected. So let's talk about what your options actually are. The default rule is this. If you withdraw from a traditional IRA before 59.5, you will owe ordinary income tax on the amount plus a 10% early withdrawal penalty. So if you pull $20,000 early in the 22% tax bracket, you're looking at $4,400 in income taxes plus a $2,000 penalty. That's $6,400 gone before you've spent a thing. The IRS does build a list of exceptions or situations where you can access funds early without the 10% penalty, even though you may still owe income tax. First-time home purchase, up to $10,000 lifetime, can come out penalty-free to buy, build, or rebuild a first home. This is one of the more commonly used exceptions, especially among younger investors. Next, we have qualified education expenses, things like tuition, fees, books, and related costs for you, your spouse, your children, or your grandchildren. Disability, if you become totally and permanently disabled. In the event of your death, your beneficiaries can access your funds without the penalty. We have the substantially equal periodic payments, or SEP Rule 72T. This is a lesser known but legitimate method that lets you take a series of structured equal payments over your life expectancy, completely penalty free. You have to commit to the schedule for at least 5 years or until you reach 59.5, whichever is longer. It's a real tool for early retirees, but it requires very careful planning. Don't go down this road without talking to a professional first. Medical expenses, unreimbursed costs exceeding a certain percentage of your adjusted gross income, and health insurance premiums if you're unemployed and covering your own insurance. And lastly, IRS levy, if the IRS levies your account to satisfy tax debt. Now, the Roth IRA has a structural advantage here that most people don't know about, and honestly, it's one of the best kept secrets in personal finance. Because you contributed after-tax money, you can withdraw your contributions, not your earnings, at any time, any reason, zero taxes, zero penalty. Let me say that again because this really matters. Your contributions, the actual dollars you put in, are always yours to access, no questions asked. If you've put in $30,000 over the year and your account has grown to $55,000, you could pull the $30,000 out tomorrow if you need it. $25,000 in earnings stays put until you hit the qualified withdrawal window, but the money that you contributed is never locked away. This makes the Roth IRA function almost like a dual-purpose vehicle, a retirement account that also acts as a last resort safety net. I wouldn't lean on this intentionally because you're giving up compounding growth every time you pull money out early. But knowing that trapdoor exists, that's genuinely reassuring for a lot of people. Compare this to the 401k from our last video, where early 401k withdrawals come with both 10% penalty and income taxes no matter what. While loans are possible, you're borrowing from yourself with a real risk attached if you leave your employer. The IRA, and especially the Roth, gives you more direct, individual control over your money. This is where the traditional IRA and the Roth IRA really go their separate ways. And it's a planning detail that a lot of people don't think about until they're deep into retirement and suddenly realize that the rules are working against them. Let's start with the traditional IRA. Here's the thing about the tax deduction that the traditional IRA gave you. The IRS didn't hand that out as a gift. It was more like a loan, and at a certain point, they'd want to come to collect. The mechanism they use is called a required minimum distribution, or RMD. Starting at age 73, you are legally required to withdraw a minimum amount from your traditional IRA every single year. This amount is calculated based on your account balance and the IRS life expectancy tables. And it doesn't matter whether you need the money or not. You take it, or you pay a 25% penalty on the amount you should have withdrawn. That's steep, though it's not as steep as the old 50% penalty that was changed after recent legislation. The planning implication here is real. If you spent 30 years building a large traditional IRA balance, those RMDs could push you into a higher tax bracket in retirement, which can ripple out and affect your Medicare premiums, how much of your Social Security get taxed, and your overall income picture for the whole year. It's something worth thinking about long before you hit 73. And for those of you who watched the 401k video, traditional 401ks carry the same RMD rules starting at age 73. So if you have both, that mandatory withdrawal clock is ticking on both accounts simultaneously. One thing worth noting, under the Secure 2.0 Act, the RMD age was raised from 72 to 73, and it's scheduled to climb again to 75 for any individuals who turn 74 after December 31st, 2032. The goalposts are moving in the right direction, giving savers more runway before mandatory withdrawals kick in. Now for the Roth IRA. Here's where the Roth really gets to shine again. Roth IRAs have zero RMDs during the account owner's lifetime. None, zero. The government will never force you to take a single dollar out. If you don't need it, it just keeps sitting there in your account, compounding, growing, completely tax-free for as long as you're alive. That's an extraordinary feature. Now, any heirs who may inherit a Roth account will have their own beneficiary RMDs to rules to navigate, but for you as the original account holder, you're never forced to touch it. That makes the Roth IRA uniquely powerful, not just as a retirement account, but as a wealth transfer tool. It's one of the cleanest ways to pass money to the next generation without handing them a tax bill to go along with it. It also gives you incredible flexibility to manage your taxable income in retirement. In a year where you want to keep your income below a certain threshold, say to stay under a Medicare premium bracket, you can pull from the Roth and it doesn't count against you. Having accounts taxed differently is like having different speed gears. You can shift based on what the road looks like. Now that we've covered the traditional IRA and the Roth IRA, let's take a moment to compare them side by side. Our contributions for a traditional IRA are pre-tax dollars, meaning they are potentially deductible this year. For the Roth, All of our contributions are after tax, so there's no deduction. For growth on a traditional IRA, it's completely tax deferred versus on the Roth IRA, it's completely tax free. When it comes to withdrawals, traditional IRA withdrawals are taxed as ordinary income at your ordinary income tax levels. The Roth IRA is completely tax-free on qualified withdrawals. For 2026, our contribution limit is $7,000 or $8,000 if you're 50 or older for both accounts. And remember, this is a combined limit. The income limit to contribute, there's no limit for a traditional IRA. There is a limit for the Roth IRA where it begins to phase out at higher incomes. For early withdrawals, on a traditional, you'll pay a 10% penalty plus income tax. For the Roth, it's a 10% penalty plus tax only on your earnings. Any contributions can be withdrawn tax-free. When it comes to RMDs, you have RMDs starting at age 73 for the traditional IRA. For the Roth, there are none during the original account owner's lifetime. So the traditional IRA is going to be best for higher earners today who expect to be in a lower bracket in retirement. And the Roth, the opposite. It's going to cater more towards younger investors, lower earners today who are expecting higher tax brackets later in life. So here's the thing I really want you to walk away with today. This is almost never an either-or decision. The smartest long-term move for most people is using multiple account types at the same time. And IRAs slide into that picture really naturally. A common framework a lot of investors follow looks something like this. First, contribute to your 401k all the way up to the employer match. That's free money, so make sure we capture it. Never leave it on the table. Second, max out your Roth IRA. If you're eligible, the tax-free growth is hard to beat. 3, go back to your 401k. If you still have room to save, keep filling the bucket. And then lastly, consider a taxable brokerage account once your tax advantage space is maxed out. IRA, and especially the Roth, fits naturally into that second spot because of the flexibility and independence that it offers. It travels with you regardless of where you work. It gives you investment freedom that an employer plan can't match, and its rules, more often than not, favor the individual. If you're a higher earner who can't contribute directly to a Roth, the backdoor Roth is a workaround that's worth exploring. And we'll cover that detail in another video. If you're still wrestling with traditional versus Roth, the honest answer is that it really depends on where you are today versus where you expect to be. Younger investors with lower income now, whose earnings have room to grow, tend to get more long-term value out of the Roth. People in their peak earning years who want to reduce their taxable income right now often lean toward the traditional. Plenty of people end up using both over the course of their investing life, which is actually a great outcome because it gives you tax diversification in retirement. Different buckets tax different ways. That means options. Options mean control, and control in retirement is everything. All right, let's land the plane here. An IRA is an individual retirement account that you open and control yourself. Independent of your employer, it's portable, and it's fully in your hands. Traditional IRAs have potential tax deductions now and taxes on withdrawals later. RMDs will kick in at 73. A Roth IRA, get no deduction now, but tax-free growth and withdrawals in retirement. No RMDs for your lifetime. 2026 contribution limits, $7,000 a year, $8,000 if you're over 50. Roth IRA has income phase-out limits for direct contributions. Traditional IRA deductibility phases out if you have a workplace plan and higher income. Early withdrawal before 59.5 triggers a 10% penalty on top of taxes, but multiple exceptions exist, including first-time home purchases, disability, education expenses, and SEP distributions. Roth contributions can always be withdrawn penalty-free, flexibility no other retirement account offers in quite the same way. The Roth's lack of RMDs make it a long, powerful compounding and estate planning tool. IRAs and 401ks work best together. Layer them. Don't just choose between them. Whether you're just getting started or have been investing for years, understanding these two accounts and making them work together is one of the highest leverage moves you can make for your financial future. The concepts aren't complicated. The accounts aren't hard to open. What matters is starting, staying consistent, and giving time the chance to do its thing. If this video helped you out, please hit subscribe, drop us a comment with any questions, and share it with someone who could use it. We're building something here for every level of investor, wherever you're starting from. I'll see you in the next video, and let's keep moving forward on the compound trail.